Hey guys, before we get started, just a quick reminder that all the information in this podcast is of a general nature and not tailored to your personal circumstances, so please seek personal financial advice before acting on this information.
Hey everyone, and welcome back to another episode of Cash Talk. And today I'm joined by a very special guest, AMP Capital's Chief Economist, Dr. Shane Oliver. Shane joined AMP back in 1984 as Chief Economist and is the current Chief Economist and Head of Investment Strategy. Shane has extensive experience in analysing the economies, investment cycles, and what current positioning means for the return potential of different asset classes. I personally, though, has been listening to Shane for many years, and his take on the economy and assets. And today I'm very privileged to, discuss with Shane some of the economic events that are happening and what's going on in the world of money. So first and foremost, Shane, thank you very much for jumping on.
My pleasure, John. Thanks for having me.
It's really good for us to have an opportunity to unpack some really topical things at the moment. If anyone thought that the investment world was boring and uneventful, I think we're in some events and some things at the moment. But before I get started into what we're going to unpack today, I just want everyone to just remember that what we're going to discuss today is of a general nature. It doesn't take into consideration your personal circumstances. So please don't go off and act on this stuff. Go seek professional financial advice before acting on any of it. But Shane, like I mentioned to everyone, I've been following you for quite some time, but maybe can you just give me a little bit of an insight about how did you get into the world of investments and economics and where did it all start? And obviously you still got a love for it. So how do you keep the passion?
Yeah, that's a good question. When I think about it, it was almost good luck. When I was at school, I loved economics, but of course, when you're at school and you study economics at school, you've got no idea what economists do. I thought maybe I'd end up being a school teacher or something. But anyway, I decided to do economics at university. I also enrolled in law, but didn't really like law that much. But when I was doing economics, I did everything I could to stay away from the financial side because I thought that was too dry and boring. But it was only into about my third or fourth year at university that I realised that there is a lot of interest in the financial world of economics. And that's when I got more involved in that. I had a great supervisor at university who really inspired me to look into issues around investing. I actually did a PhD thesis on speculation in investment markets. These days you'd call it something like speculative bubbles or behavioural finance in investing. But those terms weren't around back then. And then that led me to a job in a financial organisation called AMP. So I've been at AMP for all of my career, but it was very much ivory tower economics back then in the early days of AMP. Well, that wasn't early days for AMP in terms of AMP's history, but when I started there, it was early days for me. And then as the years evolved, I sort of got more into the investment side of things and loved the job I got into, which basically involved taking economics as a discipline, applying that in terms of analysing economies, but also in particular applying that to the analysis of investment markets. And then, of course, at the same time, I got to get out there and meet clients. I mean, these days it's been a little bit limited in the last couple of years. A lot of it's been electronically as opposed to face-to-face. But for much of my career, I was out there face-to-face. So you got that mix of, I guess, something you love, economics, combining that with, in some ways, maybe helping people become a little bit more au fait with what's going on, putting things in context. I reckon it's part of my role to put things in context. We go through events like we're going through right now, and I think it's important to be able to go back through history and say, well, we've seen this before. Not quite the same. The events are always different. The names are different, but the basic principles of economics will repeat and remain the same. And that, I think, is useful for investors to help them stay the course, if you like. And one of the things I've learned through my whole career, just how difficult it is to time markets perfectly. You put a lot of effort into it and get something roughly right, but still you're going to get caught out at key points in time. But for ordinary investors, it gets even harder again. But one of the things I love about it is helping inform people about what the underlying economics and financial news means to them in simple language, rather than getting too bogged down, which I guess is what a lot of the media does, or getting too alarmist, which what a lot of the media certainly does.
Yeah, and that's a great, first and foremost, it's a great story, and for you to be at AMP for so long and continue the message. And for me, I started back in 2002, three, something like that. And I still remember, you back then putting out really. I think you hit the nail on the head, which is like simple language, easy to understand and easy to digest, but was very impactful. And I think that's what I related to very, very well. And I'm not sure how long Oliver's Insights has been kind of running for, but it's been going for a while. And we used to circulate that to a lot of people, and even still today. One of your charts earlier this year in 2022 was really good about climbing the mountain of worry, and just creating simple graphs into easy language for people to understand, which has been great. So thanks. And I see obviously still the passion there, which is obviously amazing. You probably hear my passion to myself, and it's very much around learning. I've learned at school and at uni and stuff a lot about economics, and obviously playing that out in my role, and then bringing that to the investments and to the retail investor or to the mum and dad, and how does that obviously impact them. So great story. And so talking about obviously a lot that's going on today, Shane, because there is a fair bit that is on this kind of mountain of worry, if you want to call it, for investors. Obviously the one that's in our screens all the time at the moment is around Russia and Ukraine. And, there's been a lot of talk around the economic effects that has to the global economy, and then the rippling effects that has locally. Obviously on the backdrop of all this was the stuff that was leading into the Russia and Ukraine, which is around kind of the inflationary pressures. And obviously when people are filling up their petrol tanks these days, they're feeling it real at the pinch. But do we want to maybe start with, Russia and Ukraine and what it means to the global economy and maybe locally, and then potentially obviously how that flows on to the inflationary pressures and what's already around?
Yeah, sure. I mean, it's funny. I've spent half of my life in the Cold War, and then the other half of the life since about 1990 outside of the Cold War, and now we're sort of be going back to some sort of Cold War, which is kind of depressing in a way. Seems like the world has become a bit more stupid again. I mean, it's not to say there weren't problems in the last 30 years, but at least you can have a degree of optimism that you're going in the right direction. But the war in Ukraine, I mean, horrible as it is on the TV to watch and see those people just like us, getting pushed out of their homes and having their homes blown up and people killed. I mean, that's just terrible stuff. But it comes at a time when we'd recovered from or recovering from the pandemic. The pandemic had set off its own problems. Initially, the fear was deflation and depression. You may recall there was a time 23 months ago in April of 2020 where the oil price went negative. And so, we've spun around in just a short space of time from negative oil price to now whatever it is, north of 100, and still going higher. I won't nominate a level because by the time anyone hears this, it'll be a different number, but it's gone up dramatically. But what happened through the pandemic was that people were stuck at home. They couldn't go out and spend on holidays and things on services, so they allocated more spending to goods. They were provided income from work if they were working at home, or from government, they got support there with JobKeeper. So it wasn't as if households were short of cash. They had the cash, they couldn't spend it on services, they spend it on goods. Suddenly everyone wants to upgrade the car, renovate the house, get some new furnishings, maybe get a boat, whatever it is. And that came at a time when production in factories, whether it's in Australia or China, was disrupted. So consequently, you got a lack of supply, increase in demand, prices go up, and we get the supply shortages we've had ever since. And then you throw into that rising trend in commodity prices. To make more things, you need more commodities, whether it's oil or gas for power in Europe. We don't use much gas for power in Australia, but they do in Europe. Metals, iron ore, and so on. So commodity prices have gone up. So then you throw in a war, and war disrupts the flow of things around the world. Russia is a relatively small economy. I was surprised how small it was last Friday when I looked this up. Their economy is $1.6 trillion US. Our economy is about $1.5 trillion US. The only thing is that our population in Australia is 29 million people, just less. 29 million people, theirs is almost 160 million people. So you can see right away, this is a country that hasn't been doing too well. It's a similar story in Belarus and the stands, Kazakhstan down the bottom. So if you're sitting there in Ukraine and you look east and you say, well, they're not doing so well. If you look west, you see the European Union, their living standards up here. Over in east, it's down there. Naturally, those people want to join the European Union and the West. But it also makes life tough for political leaders in Russia because they might want to wag the dog given their economy hasn't been doing too well. But anyway, cut to the chase, small economy, but it produces 11% of the world's oil. This is Russia. It produces something like, combined with Ukraine, it produces something like 14% of the world's wheat. So you've got a situation where the supply of those things is suddenly disrupted. Now, of course, the sanctions have initially been targeted at allowing that energy to flow through. But now there's more talk that either the Russians will cut off the energy, that is, or they'll cut off the West will put sanctions on Russian energy supply. So that's led to uncertainty. And in any case, there's a lot of companies, shipping companies, saying, well, we're not going to ship any oil out of Russia anywhere around the world. We're not going to touch the stuff. We're going to self-sanction. Whether we've got a formal sanction or not, we don't want to do it. So all of these things are flowing through into a surge in oil prices, surge in wheat prices, surge in metal prices, and at the same time, defence spending is going up. So that means more demand for all these metals and things, and that's obviously adding to inflation. The pointy end of that for us here in Australia is obviously the petrol price at the Bowser. The world oil price, as of today, it's pushed up to around $130 a barrel. It's come back a little bit, I think, in the West Texas, the US one, but in Asia, it's about $130 a barrel. Even with a bit of a rise in the Aussie dollar, it still translates to petrol prices of $2 a litre or more, depending on what grade of petrol you buy. So that's a bit of a shock. And for Australian households, it means that an average household which consumes something like 35 litres of petrol a week, now maybe a little bit less these days because not as many people go to the office, but in a normal environment they'd be consuming about 35 litres a week. Do the maths on that. They're paying or will be paying something like $15 a week more than they were just 3 months ago back in December, and you multiply that out, that's $750 a year, which is quite a hit to household spending power. So that's the big drag. So you've got this inflationary boost, and you've got associated with that a hit to consumer spending power, and that's why the share markets are worried. They're worried about higher inflation, and this, some people would immediately realise this is stagflation. You're worrying about higher inflation, like we saw in the 70s, but at the same time, slower economic growth. And in the 1970s, that was labelled stagflation. Now, some countries are more vulnerable to this than others. Europe is probably the most vulnerable because they're the most dependent on European oil and gas. The US, believe it or not, is a net energy exporter. They do import some oil from Russia, but they could probably in time substitute that for oil from Mexico and Canada and get around. And their own shale oil production will ramp up dramatically on the back of this. So they'll probably survive. And in Australia, we're an energy exporter as well. So there's a national benefit in the sense higher prices for our exports, more money going to Canberra, and maybe they can give tax breaks or handouts to households in the budget in a couple of weeks. So it's pretty bleak, but by the same token, Australia and the US aren't as badly off as some other countries, and we probably won't go into recession, but we will see higher inflation.
Are we seeing, Shane, a shift? Are we seeing, Shane, a shift? And what I mean by that is obviously there's disruptions on the equity markets. We're seeing them kind of come off. But what I'm hearing here as well too is that governments are obviously reallocating, where they're importing, where they're exporting, all of those things, and this is shifting. We are obviously seeing inflationary issues, but these inflationary issues, were they around before the Russian and Ukraine issue? Because there was a lot of money pumped into the economies. We talk about JobKeeper. I think, if my memory serves me right, it was about 386 billion or something that was pumped in. You might quote me on a better number than that, but I think it was roughly around that. But around the world,
it wasn't quite that amount, but it was a lot of money.
A lot of money, but we'll take it. We'll throw a few on top. But anyway, what I was going to say to you, around the world, obviously there was a lot of stimulus in the kind of COVID scenario. Is this kind of the two just happening together, and what's your thoughts around governments fighting against this? Because a lot of people are concerned when you talk around this scenario where we've got this, call it stagflation, happening, that governments are not really prepared for these scenarios, but it did happen in the 70s.
It did happen in the 70s, and it took them a long time to get it back under control again. I mean, if you think about it, the 70s were part of a reaction to the 1930s. So in the 1930s, we had depression, falling prices or deflation. It took a while to get out of that. We had World War II, but when we came out of World War II, policymakers, governments, central bankers, they were all focused on avoiding depression. And so we saw an expansion in the size of government. We saw protectionism. We saw increasing money supplies. They used increased money to pay for the Vietnam War. And that ultimately broke out in lower productivity in the 1970s, slower economic growth, in other words, and higher inflation. And then we got the OPEC oil shock, which then boosted the inflation from a relatively minor problem to a very big problem. And it was only in the 80s and 90s that they got it back under control again. And they did that by supply side policies. You may recall Reagan, or have heard of when you were younger, Thatcher, Keating and Hawke in Australia. They deregulated economies, opened them up. We had globalization, which was a good thing in a way. China and Russia and Eastern Bloc countries came into the world, lots of low-cost producers, lots of competition. And that all helped bring inflation down and boost productivity. Now we're seeing the reversal of that to some degree. We saw lots of money printing through the global financial crisis years, but it didn't really result in much inflation because at the same time, governments were doing fiscal austerity. You know, the focus in Europe and the US was cutting back on government spending. When we got to the pandemic, all of that was thrown out the window. We saw lots of money printing and we saw lots of government spending. That government spending and money printing was probably necessary to avoid a worse outcome through the pandemic, but we're now paying some price for that in the form of higher inflation. And even before Ukraine, the US was seeing its highest inflation rate since the early 80s at around 7 or 8%. And likewise in Australia, we've seen inflation pick up, although it's far less of an issue in Australia than in the US, but other countries have seen the same. So there is an element of lots of money sloshing around, chasing fewer goods. So at some point, production will pick up and people will allocate more money back to services, less on goods, and inflationary pressures might come off a little bit. But you've still got this underlying change in the economies we're in, that they've become less competitive. If we're moving into a world where there's an iron curtain down there through Ukraine, as President Zelensky said in the last week, the noise is not the fire of guns, it's also the lowering of the iron curtain. If we're moving back into that sort of world, then that's going to mean less competition globally and higher prices. You've got a bunch of baby boomers. I don't want to extol the benefits of baby boomers, but when baby boomers entered the workforce in the late 60s and early 70s, they were the young people. You need young people in the workforce, but they're often not that productive when they first start. Like I reckon I was most productive, probably my peak was when I was about 48. That's just my rough estimate. I'm still pretty productive now, but the baby boomers are now retiring, but you've got a bunch of millennials coming in, which is well and good. That's just the nature of the world. But those millennials are less productive than the baby boomers who are retiring. So that also leads to a bit of inflationary pressure, a bit more wages growth than we've been having lately. So there's a bunch of factors suggesting we're moving into a world which is somewhat more inflation prone, maybe a little less productive than it's been, which isn't so good. We're hearing today from the Prime Minister saying, well, we need to think about making more things in Australia, which is what Ben Chifley said after World War II. We need to make the Holden car. And I, of course, bought Holden cars, and of course, not enough Australians bought them, so Holden went out of business here. But we're sort of moving back to that world, which is a little bit more protectionist. I like to make things in Australia, but I'd rather we do it without sort of inducement from government to do so.
And I think you can also look at the Trump scenario where, when you said those things and he was like, make America great again, bring, as much as we can back to America. It probably has been happening for a little bit, this kind of bring back away from this kind of the globalization. And I'm sure that there was other underlying things in regards to the way that he was talking about that. But, we are seeing that. But what are governments doing to kind of combat this, or what's in their arsenal, Shane, to kind of combat this stuff? Because when we talk around, the RBA, for example, we're at cash rates that are at, record lows still. And usually we got told in the old textbook, if inflation comes, they increase the cash rate. But then that has an impact on households as well, coupled with, what's going on with the Bowser, let alone what potentially could go on with their home loans. What's in their arsenal and what do they need to kind of be concerned about?
Yeah, it's complicated with all of these things in economics. I mean, obviously, governments might think, oh, well, we'll have a price freeze, or we'll just criticise companies for being uncompetitive or ripping people off. Those sort of things, they don't work. Nixon, and I think in Australia we tried price and wage freezes in the 70s, and they just don't work. It just suppresses something that pops up later.
It was Keating, I think, that Keating wanted to do it, didn't he? He said something about it, I think, when he was in power, or maybe treasurer at the time. I think he came even out and said he wanted to do wage freezes, and everyone frowned upon it back in the day. I think it was him anyway. So yeah, I don't think not many people like freezing of wages, but I'll let you keep going.
They don't work. I mean, it's just, it's sort of just trying to suppress something and then it pops up somewhere else as a problem or later on. So that was a complete failure. I mean, Keating, to his credit, deregulated a lot of things, so ultimately set us down this path. I think him and Bernie Fraser were the ones that came up with the 2 to 3% inflation target, which we still have. That's what central banks are still charged with achieving in Australia. I mean, ultimately, it's a combination of things. We probably are going to need tighter monetary policy, higher interest rates, but it comes with two complications, in fact. One is household debt today is a lot higher than it was in the 70s. It's the ratio of household debt to income is maybe 4 or 5 times what it was back then. So you can't raise interest rates too much without causing problems in households. And the flip side to that, of course, is that the Reserve Bank knows that, and therefore they only want to raise interest rates a little bit to slow things down, take the edge off things. So therefore, monetary policy is arguably more potent than it was back then. Like, I reckon a 0.25% interest rate hike today is equivalent to almost a 1% interest rate hike in the late 1980s. So you won't need to raise interest rates as much, which is probably a good thing in some ways, but obviously higher interest rates will slow down the property market. The other aspect is that you're dealing here with mainly a supply side problem. It's the supply side which is lacking, and governments, I think, therefore have to play a big role in that. They need to find ways to supply cheaper energy so we're not dependent on Russia. Now, obviously, some of that's going to involve sustainables, and given the targets to move towards a decarbonised world by 2050, zero emissions, increasingly we're going to end up relying on sustainables. But there is an interim period where they've still got to rely on some dirty stuff. Europe, for example, can't rely as much on gas, or probably won't want to rely on gas from Europe much, from Russia much. So they're going to have to rely on other stuff and some dirty stuff in the short term before they get to that phase where it's more sustainable. So obviously energy supplies need to be secured, but in a way that ultimately gets us towards a more sustainable world down the track, cleaner energy. Also making supply chains operate smoothly, making sure there's enough competition out there, making sure that there's not so much regulation. We went through a period of intense regulation in recent years. I know we all think of the industry we're in, such that it's now very expensive to get a financial planner. So that's a high cost for people who don't have a lot of income, but they may need a financial planner. Look at ways to reduce that cost so people can get access to a financial planner at a reasonable cost. So there's lots of things that can be done to make sure the economy operates as smoothly as possible, such that businesses aren't encumbered with unnecessary regulations. You look at costs in Australia, we have very high cost housing because our infrastructure is all designed such that we live in the city or in a big city, Melbourne, Sydney, Brisbane, whatever. The pandemic has shown that maybe we don't all need to live in the cities. We could all have more people living out in Ballarat and Bathurst and Orange and so on and so forth. But we've got to make sure that the infrastructure is there and that those regional centres are able to supply the housing and make it easy for builders to get out there and supply that housing to allow that to happen. If you do that, you save massive amounts of cost and made it easier for young Australians to get into the property market. So there's things that governments need to do, but They're not easy fixes. They're things that take time, just as what Paul Keating and Bob Hawke and Reagan and Thatcher did in the 80s. That took time to bear fruit. But they're the things governments, I think, really need to be thinking about right now.
It's very interesting you said about the potency of an increase in interest rates. And I was just with people who have never experienced an interest rate rise before. We were working with our our younger clients, and I was just explaining to them what, like a 1% increase would look like, and I kind of said to them, on a $600,000 mortgage, 1% is an extra $6,000, $500 a month. You're going to find it. Yeah. Where are you going to find it from? And, just understanding the potency of that, I understand. So, maybe they don't need to, go out and do what they did back in the 70s and, really try to, increase at rapid amounts to bring that down. So great tips. I think the other one that I was hearing as well too is that there's a lot of moving parts here. Okay, there's a lot of moving parts, and this is probably something that's not going to be settled, in the next couple of weeks. So Shane, how for it to go back to, supply issues being kind of resolved, what's a kind of expectation in regards to a time frame for you to see come back to like some kind of normality?
Pushed out. There was a time last year where the Federal Reserve in the US said it was transitory. It became the favourite word of some economists and central bankers. It's transitory. And then here we are almost a year later, and we've still got the inflation problems, and they haven't resolved, and then Ukraine's made them all worse again. Like a reasonable time frame in Australia, I think, is probably 12 months. It's really this: if we can continue with the reopening, and I know we haven't mentioned COVID much so far, but if coronavirus remains less harmful and the vaccines continue to help, then we can continue with the reopening. And hopefully we can go on overseas holidays again, which means it takes some of the spending pressure off goods back onto services. And at the same time, as production ramps up in countries around the world, then that should start to get prices down. So that's the good news, that some of this inflation pressure will come down, and we will get to a point where we'll be oversupplied with furnishings. You go down there, now there's a shortage of furnishing, you'll get to a point where there's an oversupply of them. So hopefully I reckon probably take about 12 months to resolve. The longer term issues that come with declining productivity, they're the ones that take longer. And adjusting to a world where part of the world is cut off from the other part of the world, it also takes a little while. Like when the Berlin Wall came down and the Cold War ended, it took us a decade or so to adjust to a new globalized world. And all these countries opened up to us. Now suddenly we're finding that, within a short space of time, it's suddenly all being closed off. Like fund managers, took years to allocate money to Russian equities and Russian bonds. Now they're unwinding their allocation within a couple of weeks.
Yeah.
It's that adjustment is occurring really quickly, but we've got to find ways to operate in this new world, being less reliant on countries that might have decided to go down a more autocratic path. Now, there's plenty of countries out there that will be friends with us. A lot of them are all near us. When I was at school, we used to talk about Indonesia. I even studied Indonesian at school. So maybe we get closer to our near neighbours again. Malaysia, Indonesia, Singapore, Philippines, and so on, Thailand. Whereas for the last 15, 20 years, we've increasingly flown over them, even though we still go there, we've increasingly flown over them to other countries.
It's a very, very interesting world, and there's a lot of moving parts. Just a couple of maybe final notes, Shane. Maybe just, I don't know, 2 or 3 tips for investors. And they can be anyone's, but if you were maybe, I don't know, speaking to, let's just start with a novice person, what would you be saying to them about what's going on and some tips that you can give investors?
Well, the first thing I would say is that investing is not easy. I know a lot of people hear, well, crypto's gone to the moon, or done really well. I should just invest in crypto, or this stock did really well, I should get in there. And it looks really easy in hindsight, but in reality, it's not so easy. So just approach this whole investing thing with a degree of humility. If you want to get into it, you've got to be prepared to put a lot of effort into it, read a lot of books, get a process to drive decisions, but most people aren't prepared to do that effort. So I think the key in all of this is to make the most of what I call compound interest. There's a well-known economist, Dr. Don Stammer, used to say the magic of compound interest, make the most of the magic of compound interest. And that's where a growth asset, like a share or property, will grow over time because it's leveraged to the economy. As the economy expands, the share market, the property market will reflect that through time. And so consequently, if you make the most of compound interest, have a decent exposure to growth assets, you'll do better than someone who just has it all sitting in the bank, and you'll do better than someone who has it all sitting in government bonds. And you can see this time and time again. If you look at the rolling 10, 20-year returns out of shares and property, they're invariably always better than you get from bonds and cash. You might go through the odd period there, but if you're thinking about your investment horizon, you are far better off in growth assets. That's tip number. So be humble, make the most of compound interest, don't get thrown off by the cycle. Whichever way you cut it, something is going to come along and rain on your parade. You're going to think, I had a great return last year, which many people did from the share market and property markets, and then history tells us that, oh, gee whiz, you're going to have a rough year next year, and that's the way it goes. And that's what we're seeing. But you don't want to get thrown off by the cycle, because if you get thrown off by the cycle and sell after the market's gone down, like now the news is pretty bleak and dark. We've got floods, we've had the pandemic, people dying, and that's been horrible. Now we've got war going on. Now we've got inflation potentially rising. It all seems pretty dark. You get thrown off by the cycle back into cash, odds are you'll never get back in. Or when you do get back in, it'll only be when the share market's gone all the way back up. Because when the share market initially starts recovering, you say to yourself, oh, it's just a dead cat bounce. Everything's still horrible. It's only when it's all the way back up, and you go, oh, gee whiz, maybe the share market had it right, and those who got in, not many people got in, but those who rode it up, they're the ones who've done well. Then you get in. By that time, the share market's back where it was when you sold out, or well above it. So don't get thrown off by the cycle. You are doing that, you're invariably locking in a loss. So it's best not to lock in that loss. Very hard to time when the market will go back up. So I reckon the key in all of this is to stick to a long-term strategy. So be humble, make the most of compound interest, don't get thrown off by the cycle, don't lock a loss in, but stick to a long-term investment strategy. And the best way to stick to that long-term investment strategy is to get a plan with somebody or other, a coach, call them a financial planner, or you might have another term for them. Get some sort of coach to help you through that and stick to it. And one way to stick to it is to turn down the noise. The more I turn the noise on, like I can't get away from this gadget here. It turns itself on, and something up there that I'm supposed to be looking at. It distracts you. People's time horizon used to be maybe, 15 minutes you sit down and read a book. How many people sit down and read a book anymore? Because you're distracted. You won't look at your phone. Like, I'm one of the worst offenders, but I've increasingly found that I've got to find ways to turn down the noise. I've turned off all the notifications on my phone. I think the only notification that works will be if you give me a phone call and then it goes beep to say that it's ringing, and when you send the message, I get a beep then. Nothing else. All the other notifications are turned off. So you've got to turn down the noise. And the problem with that noise is that you've got traditional media at the present, which is TV and radio and print. They're trying to compete with the social media. And guess what? There's a huge battle on there for your eyes and ears. And unfortunately, they've had to become shriller. And how do you get more eyes and ears looking at your stuff? Well, you put more and more negative stuff in there. Bad news sells. So I used to get the paper, and you get a reasonably balanced flow through. As you go through it, you have the headline there, which might be bad news. That got you into reading it. But then you'd get a reasonably curated, whether it's Murdoch or Fairfax or whoever, you get a reasonably balanced view of the world as you go through there. Now, if you're just reading it on the online version, you just look at the clicks, what do you click on? Usually click on the things that are salacious, bad news, look interesting, all that sort of stuff. But you're not getting that balance. So I think, turn off don't look at it so much, but when you do, look at the old print version, or you can ask for the newspaper version of the paper to get a more balanced view of the world. But I think at times like this, you've really got to find something more entertaining and relaxing. I used to watch old Brady Bunch episodes, maybe a bit dated. I'm sure it had a big impact on me, but watch a movie, a fun, happy movie or something. got to find a way to turn down the noise. That helps you stick to a long-term investment approach and avoids getting thrown off just at the wrong time.
They're absolutely great tips, and for the people that have been listening to me, and obviously even the clients, I 100% agree with everything you say, Shane, and not to the point as I just tell people. I do it myself. People are astonished when I tell them that I don't look at the stock market every day. I don't. I don't want to look at the stock market every day. It's trying to take my money away from me. And turning down the noise is huge.
It is. I did a stat on this. I did a stat on that. You look at the nightly news, you look at the finance update and the news program, it's 50-50 as to whether you're going to get good news or bad. If you push it out to 1 year, in Australia, it's something like 80%. You push it out to 10 years, and I'm not saying just look at it every 10 years. Push it out to 10 years, it's 100% you're going to get positive news. So it's really messy, day to day or even month to month. You're certainly best not to look at it on a frequent basis.
And I think the other thing as well too is just for all the investors out there is there's a lot of people trying to take your money away from you. There's not a lot of people that are trying to put your money in your pocket. And on me as an advisor who obviously works with my clients all the time, I'm really trying to control their behavior and the way that they do things. And Shane, over my career, I've really tried to emphasize that the behavior of the individual dictates so much of what happens with their money and their performance in regards to their performance of their portfolios or their wealth creation or whatever. It's got a lot to dictate what goes on between the years. And in sport, you hear it all the time. It's 90% above the shoulders when it comes to investing, wealth creation, or whatever it is. It's exactly the same. So Shane, absolutely great tips. And Shane, for the people that think that this is, this current scenario is never going to end, they might feel like, as you see, there's all this bad news and all this, oh my gosh, this is like, it's never happened before like this. We're going back into doom and gloom. What would you have for that person that's maybe feeling a little bit, like that?
I would just say, look back through history. We've seen some terrible times, World War II, World War I, Great Depression, gone through the GFC, Aussie markets fell 50-odd%. But, we pull out of it. The history of things is invariably, it turns out okay. In good, well-managed countries like Australia, it turns out okay. Even though you can go through these periods of pain. And for investors who stayed the course, they got the benefit of that. So that to me is the way to look at it. I mean, these things have happened before. I mean, that wall of worry chart or mountain of worry, that's what the share market does. It climbs that mountain through time. And it's able to do that because at any point in time, there's usually lots of people worried. So the share market doesn't fully reflect the better times that come down the track because there's usually some skeptics holding it back. And so consequently, it's able to climb negative news. Look, like think of last year. I mean, we went through that 2020 rather. We went through that horrible period from late February 2020 when the news on coronavirus got worse and worse and worse and worse until late March of 2020. I think it was precisely February the 23rd to March the 23rd.
Yeah,
seemed to get worse and worse. Went down, then suddenly the markets find a bottom. It was 35%, 37% lower for our share market. And then it just sort of started grinding higher against everyone's belief. Everyone's saying, well, how can that be? The share market's gone bonkers. But it's the way the share market works. It falls out of bed every so often, like it is at the moment. Well, not as much in Australian shares are holding up a bit better because of resources shares, but in other parts of the world, closer to the conflict with Ukraine, it's falling out a bit. And then eventually it finds a low. That's the history of these panicky periods. It finds a low and then starts grinding higher again against a lot of people's disbelief. And that's the wall of worry that it climbs. But it's these periods of volatility which give us the higher returns from the market. To some degree, it's the price you've got to pay for getting higher returns over time from shares and also property compared to what you get from, say, just having your money sitting in the bank.
Yeah. Great tips, Shane. And Shane, it's been an absolute pleasure having you on today. I really do appreciate it, and to understand obviously the world of what's going on and how that relates to investors as well. So thank you very much for giving us your time today. I really appreciate it.
Thanks, Ron. Great to be here, and all the best, everyone. Take care.
Thanks.